Talk stocks. Ed Yardeni, please come on in here and let's get started. I don't even know where to go other than, am I right that's the word of the week, resilient? The equity markets are resilient.
Resilient, bulletproof, Kevlar vests. You know, I mean,
is that a surprise?
I'm not that surprised by it, but I'm impressed. I definitely am impressed. I mean, we've thrown so many things at this market, and it's held up remarkably well.
Is it the underlying earnings belief?
Absolutely.
And that maybe corporations are more optimistic than the analysts following them?
I think so. Corporate managers are looking at all the same issues that investors are looking at. The difference is they've got to solve these problems and to figure out how to make money, and they're doing it. And then investors and analysts are looking at the results and saying, this is pretty impressive stuff.
Whether I talk to you or, say, Tobias Levkovich this morning, it's about these sectors and getting in the right sectors. What's your favorite sector right now?
Well, energy has been my favorite sector for quite some time. Certainly this year, it had a nasty sell-off at the beginning of the year, of this week, I should say. But I think it's going to make a comeback. The important thing is that at $150 oil, it's bad for energy. Stocks is bad for all stocks, and I don't think we're going there. And I don't think we're going to go back down much below $100 either.
If you take the banks out of energy and transportation, aren't we through record highs right now? We're about there, aren't we?
Yeah, we're
if you take out the banks.
Yeah, absolutely. And the banks still have a lot of challenges, as we're seeing. They're reporting great earnings, but that's largely by reducing their write-offs.
Dreaded first chart. Let's bring it up here. Transports drive through Dow 14,000. It really depends what area you're in. Here's transportation on a boom. Look at it just blow right through.
Yeah, it's extraordinary.
Those 07, 08 highs. That's the S&P 500 blended transportation index, and you're still in there even with that outperformance.
Yeah, the railroads have been acting just great. The air freight and logistics have been doing extremely well. And this is with the energy prices going up. This was the oil prices going up. They've obviously been able to pass through these costs, tremendous productivity. And look, the railroads have all these commodities to transport that are worth more.
And part of this that I think is so important is being multidisciplinary, where you look at, say, M&A, that game changer, Texas Instruments National Semiconductor. May I suggest, with your decades of experience, that's a real clarion call to CEOs, chairmen, and CFOs. What's the valuation of my company in the private market?
Well, as we've said, the profits have been extraordinary, and that's gone straight into cash flow. Corporate cash flows at an all-time record high. A lot of corporations still sitting on an enormous amount of cash, but they're earning nothing on it. And so I think you are going to see a lot more M&A.
Can you discern that in small cap, in mid cap, or when we say corporate cash flow is there, do they have it as well as the big companies?
I think they have it as well, but they tend to be the targets for these M&A deals, and that's why their valuation multiples are higher than they are for the large caps.
Let's see that on a chart. This from Jason Trenner. Ed Yardeni considers small cap outperformance, and this is just NASDAQ 100 to the S&P 500. It is Apple infected, affected, maybe would be the right. There's a worm in it somewhere from the Apple. But the fact is, small caps, NASDAQ 100's been doing better. Do you go with the big cap?
The earnings momentum of small and mid cap has been actually much better than large caps. Large caps, however, are very cheap on a valuation multiple basis. They're selling around 13 times forward earnings, whereas the large caps, mid caps are more like 15, 17.
13 times forward earnings. I mean, that's on the edge of Japan.
Well, they are cheap, that's for sure.
Now look at the chart. Let's bring it up here. A real nuance here with consumer discretionary. You've got consumer discretionary, which does better if oil comes back just a little bit. You can see the outperformance there. The white line is that transportation series. We normalized it back to the peak. And there's that lag. You like to take advantage of that lag, don't you?
Well, look, the consumer discretionary stocks have been on fire during this entire bull market. They've been a leadership group, and who would have thought, right? I mean, for all the pessimism about them having to retrench and deleverage and all that, and yet the retailers' stocks have done extremely well, and I think that continues to be the case. The country is sort of bifurcated into the haves and have-nots, and the haves are still spending money.
How do you short the have-nots? I'm not supposed to ask that question.
I don't think
it's not a nice question.
It's not a nice question. You're right, but you know, the reality is that some of the stores that cater to people with lower incomes obviously have been struggling. But look, the have-nots are getting support from government payments of various kinds, and so on balance, the economy is doing pretty well.
Do you need a 4.5% or 5% nominal GDP to make this market continue higher? Or can it continue higher, as we've seen with profits, even if you don't get a really good GDP statistic?
Well, I think we can muddle along. I mean, I think real GDP may very well muddle 2.5% instead of 3.5%. So I think we can muddle along and still the market still does well.
Okay. You pick a stock. What's the first thing you do when you say, I want to buy a stock?
Well, you know, I'm a top-down investment strategist and economist, so I start from the top and I work my way down. Obviously, there's a lot of people who work from the bottoms up. But I tend to focus on the macroeconomic environment and sectors. I really look globally. And to me, it looks as though we've got a global boom going on. For all the problems we've had for the past 2 years, we've had a global boom. And so it's the beneficiaries of that global boom that I'm looking for.
The shift in emerging markets from bonds over to equities is presumed. Do you buy that idea?
Yeah, well, look, these emerging economies, suddenly it's not a perfect story. Now they have an inflation problem as food and energy prices have gone up. They're subsidizing it, so maybe they have a fiscal problem as well. And so the focus naturally is shifting away from fixed income, which really was the global investment theme for most individual investors for the past 2 years, now back to equities.
Let's bring up this from Bloomberg Surveillance this morning. Earlier this morning on Bloomberg Surveillance, I spoke, well, there's an elegant chart.
Right.
Okay, let's look at that instead, and then we'll talk about Jeff Hirsch. It's a decade, one did well, one did not. I mean, you're picking a stock, and you're top-down guy. There's IBM in white, and Intel, and okay, I picked a winner, and I picked a laggard. I mean, that's obvious, but to go top-down and look at economics into investment.
Right.
I say economics, finance, and investment, and I really believe that. How do you bridge that from economics over to getting it right on IBM and
well, look,
avoiding Intel?
There's all sorts of different disciplines for investing. There's technical analysis, there's bottoms-up, where you really do get to know the companies. You listen to the conference calls very carefully. You do your homework. And then there's other approaches like the one I tend to favor because that's my skill set, if you will, and that's to look at stocks from a global economic perspective and sort of drill down to sectors. But it's not, that approach isn't going to get you to discriminate between IBM and Intel, for example.
Right, worrying about deficit, worrying about the gloom out there. Earlier this morning, folks, talk about optimism. I spoke with Jeffrey Hirsch, president of Stock Traders Almanac. His new book, Super Boom, talks about Dow 38,000. We talked about market timing.
Market timing has worked for people. If you bought and held 2,000, you weren't too happy. But if you start buying and holding over the next 5 years, I think you'll be quite pleased in 2025 and beyond. There's a time for buy and hold, and there's a time for timing. I think the sideways markets are the time for market timing.
Jeff Hirsch, Super Boom. Okay, I'm thrilled to link the two of you together.
Right.
That super boom is predicated on a good economy,
absolutely.
By definition.
Yeah, absolutely.
There has to be an optimism and a realism. When you see the articles, the American experiment, stealing from James McGregor Burns, the American experiment is ebbed, how do you respond?
Well, look, I think the pessimists have tended to focus on deflation, debt, possible depression. I think what they're missing is productivity, profitability, prosperity. So there's the 3 Ds and the 3 Ps. And I think the bears have just been too obsessed with just one side. They haven't really had a balanced view of what's going on. And I think you really do have to start on a global basis. If you look at the global economy, it's actually been booming ever since the end of the Cold War. You didn't see it that much in the 90s, but you clearly saw it during the last decade. And I think that boom is back.
I want to come over, Matthew, see if you can come on over here. This is that animal spirit. Okay, it's a little confusing here. $28 a share. On the first day of trading, Ed, this is when you and I had less gray hair. Zipcar, it was at 18, which was overpriced. It's up $10 off the IPO. It's traded off a little bit, but would you suggest with the animal spirit of America that we can revert back to that entrepreneurial M&A business and an IPO business?
Well, I think we're there now. I mean, when you look at corporate profits, you've got to be extraordinarily impressed by how well companies are being managed in the face of all the adversities. And so we must have some awfully good managers running companies, and they're doing this on a global basis with all the challenges that are going on. And I think that, in turn, feeds into that resilience into the market.
Many opinions on the deficit, including the president's comments an hour ago or so. Here's Margaret Carlson. Let's bring it up here. What an essay by Carlson, of course, tilting to the president. The president finds his voice on cuts that matter, the gap between Wall Street enjoying shocking profits, and the janitor living in a trailer park has never been greater. It's going to take many more speeches for the president to bridge that divide. Ed Yardeni, you're one of the great voices of Wall Street. How does Wall Street, whether it's Mr. Blankfein or Mr. Diamond, or it's somebody, say, in Des Moines with a client book that's just recovering now, how does capitalism come back to America?
Well, to tell you the truth, I haven't been physically on Wall Street for quite some time. I'm now independent, so I tend to have maybe a more objective view of Wall Street than if I was working on the street. I think Wall Street has a credibility problem. I really do. And I think they still have to clean up their act much more so than they have.
What would you like to see?
Well, I think the too big to fail issue has not been resolved, and I think some of these companies really need to be chopped up, and you know, we need to set some sort of rules about how, for example, what percent of total deposits can a commercial bank have for the entire?
They'd like more, and you're saying less.
Absolutely, they're just too big.
Wonderful. Thanks so much for coming in today. Ed Yardeni, Associates as well.